I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, liftoff. Ride-sharing's number 2 company kicks off the IPO race with a public filing. Plus, Hunger Games. New reports say Amazon is planning to open dozens of grocery stores in the United States. How does this fit into the tech giant's overall retail strategy? And where no man has gone before, SpaceX is on the brink of what could be its biggest milestone and most crucial launch to date. But first, to our top story. Canada's Department of Justice said it has issued an order to formally start the extradition process for Huawei Chief Financial Officer Meng Wanzhou. The U.S. alleges she lied to banks to trick them into processing transactions for Huawei that potentially violated Iran trade sanctions. I want to get to Bloomberg's Josh Wingrove in Ottawa, who has been following this case. So, Josh, how will the process proceed from here?
Yeah, this was a sort of significant step, but also a procedural one that most people expected. And now we go to the actual hearing process that has a lot of sort of twists and turns to it and opportunities for appeal. These things take a long time. They can take years, in fact, in Canada. And then after that, if that leads to an extradition order, the final call goes to Trudeau's Justice Minister, the Federal Minister of Justice, who's currently David Lametti, to sort of say yay or nay. So many steps remain on this one, but that doesn't sort of dampen the significance of moving forward. The Chinese government is already speaking out, saying that Trudeau is politicizing this, or at least caving to the U.S., who's politicizing it.
The Chinese embassy in Canada saying they're utterly dissatisfied with this decision. This is not merely a judicial case, but a political persecution against a Chinese high-tech enterprise. Of course, there are broader geopolitical forces at play here. We're in the middle of a trade war with China. How will the trade war tensions impact this process and vice versa?
I mean, it's been hanging over everything, particularly when Donald Trump said that he might order the case to be ended against Ms. Meng if he got a trade deal he liked. That really took the legs out from under Trudeau, who'd been saying that this is the justice system is handling this. We can't interfere. This is sort of, it'll go its course. So Canada looks to be caught in the middle, of course, between these two trade giants who are jockeying for position. Remember, China has since also seized 2 Canadians and sentenced a third to death on drug smuggling charges. So a lot of analysts think that that's either direct or indirect retaliation for the arrest of Meng Wanzhou, who is free on bail pending this whole process. So a lot of moving pieces here that really complicate life for the Trudeau government, which just really continues to try to keep its hands away from this case.
Indeed, a lot of different forces at play. Bloomberg's Josh Wingrove in Ottawa, who will be covering this for us. Josh, thank you so much for that update. Meantime, Lyft has filed for a U.S. initial public offering, giving the public a first look at crucial new financial information about the ride-sharing company. From the filing, we learned Lyft's revenue is growing significantly. In 2019, it generated $2.2 billion, doubling the number from the year before, but losses a real problem, totaling just over $911 million in 2018. For more, I want to bring in Bloomberg Deals reporter Olivia Zaleski and Tim Sullivan, CEO of Oceanic Partners, a Lyft investor. So Lyft is losing, half as much money as it's making. Olivia, what are the significant takeaways from the S1?
Absolutely. I mean, people were certainly very excited about the revenue growth. They nearly doubled their revenue to $2.2 billion, but also with that came very significant losses. We're looking at $911 million, which is a growth of 77% over the year before. So I think investors seemed very excited about Lyft, but also, a lot of questions about the losses. But, this is nothing new. Most technology companies nowadays, when they go public, are losing money.
Right. They're making more money, but they're also losing more money.
Exactly.
Tim, what do you think when and now we know a little bit more about how Lyft's business compares to Uber, and Uber's revenues in 2018 were $11.4 billion.
I think that Uber isn't growing, and I think that Lyft is. Year-over-year growth of 2x on revenues and bookings at $8.1 billion. $911 million loss is acceptable. They're on path to complete the vision that they're after. I don't think that the S1 was really that surprising. We knew what we were expecting. A lot of the numbers that came out. I'd say maybe the biggest surprise for us was how much of an impact Lyft is having in communities. 34% of Lyft drivers are spending more money in their communities. 47% are spending or exploring their communities more. So that's a massive impact that I don't think we expected. And back to the numbers, the 45.5% contribution is something that is amazing and astounding.
I want to push back a little bit on your comparison there to Uber, because yes, if you look at the full year, Lyft growing 100%, Uber flat. But if you look at the fourth quarter of last year, which is the most recent quarter, Lyft grew 58% in terms of bookings, Uber grew 30%. So but Uber is still growing as of the fourth quarter.
Uber's only growth driver right now is Uber Eats, which I would argue is not in line with social responsibility value that Lyft is after. Keeping people at home and delivering food is not necessarily going to have a positive impact on the communities, on relationships, on things that actually grow our society.
Olivia, is that a fair assessment?
I thought we just cared about money here, but okay. Yeah, I was actually surprised. When we were expecting the S1 to have something about food, we thought maybe Lyft would mention that in the S1, that they would be exploring a potential Uber Eats competitor, but they didn't mention that at all. They really stayed focused on transportation. I think that's the key sort of theme here that we're seeing, is that Lyft is really selling itself as a focused transportation provider, and Uber is going to come out and it's going to be all things to all people.
Now, Tim, when you look at the risk factors, though, Lyft doesn't mince any words. Risk factors: sustained losses, expenses will continue to rise, it might not be able to achieve or maintain profitability.
I think that's boilerplate. Every S1 I've ever read has the exact same set of risk factors.
So talk to us a little bit more, Olivia, about the risk factors and how investors responded when they saw the filing today.
So, I spoke with several investors today. A number of them, the risk factors in the S1 make it very clear that Uber is a huge risk factor for them, and people mentioned that. But it does seem like there is room for both, and that Lyft's market share is gaining in the U.S. They have now 39% of the U.S. market. They used to have 22% in 2016. Other risk factors are the founders, actually, which is really interesting. They have now outsized voting rights, 20 votes per share. So that's putting a lot of trust and faith in these two founders. If something changes, maybe perhaps if, God forbid, something happens to one of them, that also changes the company significantly.
Right, and we don't know what those 20 votes will actually mean in terms of control, but it's certainly a significant point. And again, not unlike other tech companies where founders have outsized control. What about international growth, Tim? Lyft is still very focused on the United States. They're experimenting a little bit in Canada. Uber is a much more global business. They have certainly experienced their share of challenges. Uber's now buying Careem, and their Middle East competitor. Does it concern you that Lyft's vision at this point is not as big?
Not at all. I think Lyft, throughout its S1, says the phrase laser focus, and its laser focus has allowed it to execute in ways that Uber hasn't. And historically, if you look at any company that has chosen the spray and pray methodology and spread itself thin across a lot of different business units and areas geographically, they've had a really hard time being successful. Lyft isn't going to face those challenges. In fact, Uber has 10% of their assets overseas in inefficient or illiquid investments that they don't even know what's happening with, and those could be written down to zero. So investors that are looking for a return on Uber versus Lyft, I see upside in Lyft. Uber, I'm just not sure. We'll have to wait for the numbers.
Olivia, where does the process go from here? When do you see them hitting the public markets?
So we're expecting to see that in mid to late March. We'll be keeping an eye. They're going to go on their roadshow, and then...
So it could be in a couple weeks?
Yes, yeah, that's the plan.
All right, Olivia Zaleski, our IPO reporter, charting the path to Lyft going public for us, and Tim Sullivan of Oceanic Partners invested in Lyft in 2015. Thank you,
Emily,
for joining us. Coming up, food fight. Amazon will reportedly be opening a new line of grocery stores. What this could mean for its brick and mortar rivals and its Whole Foods business. That's next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Amazon is said to be planning to expand its grocery stores in the United States with new locations outside of its Whole Foods chain. The new stores will open starting in LA as early as the end of this year, with plans to expand to Seattle, Washington, D.C., and more cities. This all according to the Wall Street Journal. Shares of some of Amazon's brick-and-mortar rivals like Kroger and Walmart dropped after the news broke on Friday. To discuss in Seattle, we've got Bloomberg Spencer Soper, who covers Amazon for us, and on the phone, D.A. Davidson analyst Tom Forte, who currently has a buy rating on Amazon. So, Spencer, what's your take on this Journal story?
Well, not a huge surprise that they want to expand their brick and mortar presence in grocery. That's the whole reason that they bought Whole Foods to begin with a couple of years ago, $13 billion acquisition. And let's remember, for every one Whole Foods, there's 10 Walmarts. Walmart's the grocery leader. So we knew they were going to expand. I think the only potential surprise here is that they'll expand without the Whole Foods brand. But even that's not too much of a surprise because there's not direct overlap between what a typical Amazon customer wants and what Whole Foods shoppers are accustomed to getting when you think of all the social value things that are cooked into the Whole Foods buying experience that are not necessarily cooked into Amazon.
Tom, do you think this is a good bet for Amazon?
Sure. So Spencer makes a lot of great points, and I think it's absolutely a great bet for Amazon. If you look at Walmart, one of the areas they're doing very well is their online grocery delivery efforts. In particular, where they enable consumers to buy the product online and then pick them up in their parking lot. So I do think for Amazon, they're closely monitoring that. They're seeing that in grocery, having physical locations is still very important. And I would argue that doing it this way, outside of the Whole Foods brand, gives Amazon a lot of leeway to sell more, call it traditional consumer packaged goods products. Think of Coke, Pepsi, things of that nature. So I think that this really gives Amazon a lot of freedom it doesn't have by doing it on the Whole Foods banner.
Now, Spencer, clarify this for us. Amazon has Whole Foods. They've got the Amazon Go convenience store. Is this something in between?
That's a great question. That's what we're not so sure of, because we even reported over the summer about a major expansion plan on Amazon Go. And if you think of all of Amazon's experiments in brick and mortar, the cashierless store Amazon Go, its Whole Foods acquisition, they've got bookstores, they've now got this kind of garage sale typey thing, Amazon 4-star. Amazon Go is the most differentiated. So that's the thing that if there was something for them to expand that breaks from the norm, it would be Amazon Go. So that's one thing we're trying to figure out, is if this will include some of that cashierless grab and go technology or not.
What if this is just Amazon Go stores, Tom? Are you as excited then?
Yes. And then I would argue then maybe it's a large format Amazon Go store. So I've long felt if they do continue to move forward with the Whole Foods transformation, there will come a time when the Amazon Go technology will be leveraged within Whole Foods. Think of the area within Whole Foods where you can get prepared food and then skip the checkout counter. So I would still be excited if this was a larger format Amazon Go store that maybe had a lot more perishables than what you see in some of the Amazon Go locations today, be it in Seattle or Chicago.
Meantime, Spencer, I want to get an update on what's happening with Amazon HQ2 or not in New York. Governor Cuomo has made a plea to Amazon, spoken with Bezos himself, sent a letter signed by many other New York business leaders begging Amazon to reconsider. Is there any chance of Amazon reconsidering?
No idea. This thing has been such a moving target. It could conceivably be something they reconsider. It could be something that they simply want everyone else to think they're reconsidering for negotiation power. Who knows? But it does make sense for Cuomo to at least give it one more college try.
Well, in speaking with some of the local lawmakers who really pushed back hard against this, when the news first broke that Amazon was even considering pulling out of New York, they said right away, this is a negotiating tactic. This is another kind of extortion. Tom, how relevant is this process, what's happening with HQ2, to the business?
Sure. So first off, when the news came out on Amazon, we published a report calling Amazon Bluff. And what we said in that report is that we do believe Amazon is trying to basically extend its influence here. And what they're looking for is really the support of the local government. And I think that's very important. So, and I still am of the belief that having a headquarters in New York advances a lot of their initiatives when you think about not only the access to talent in the largest city in the U.S., but in media, in advertising. And I'm not ready to throw in the towel. I think this is the story still going on here.
Spencer, have any of the New York lawmakers that have been so against this, are any of them changing their tune?
Not that I've seen, but I'll throw out one other possibility is Amazon could be in New York City right now negotiating a lease deal for an office space without any government involvement at all. So that's another possibility is they simply decide, you know what, all the fanfare around HQ2 and the tax breaks aren't worth it. They've already got operations in New York. They still have reasons to want to be there and hire ad executives and media personnel or even finance types. So they could still just grow there organically without all of the give and take with government.
All right, our Spencer Soper in Seattle, along with Tom Forte of D.A. Davidson. Lots to continue to follow on the grocery stores and what's happening with HQ2. Thank you both. Coming up, VMware releases its fourth quarter results. CEO Pat Gelsinger tells us what to expect from the company's partnership with Amazon next. And Bloomberg Technology live streaming on Twitter. You can check us out at Technology and follow our global breaking news network, TikTok, on Twitter. This is Bloomberg. eBay announced Friday that it is entering into an agreement with hedge fund Elliott Management and Starboard Value to conduct a strategic review of its portfolio. Elliott partner Jesse Cohn and Matt Murphy of Marvell Technology Group will join the board as the hedge funds push the company to improve profitability. eBay said it will add a third new independent director later this year. The company will review assets including StubHub and the Classifieds Group and announce the findings at an event this fall. Shares of enterprise software maker VMware rose Thursday after posting fourth quarter results that beat estimates. The company saw revenue in the quarter increase 16% from a year earlier, driven by growth in key areas, including its hybrid cloud business, as the company continues to carve out its role in the cloud market through a partnership with Amazon Web Services. Joining us to discuss, we've got VMware CEO Pat Gelsinger. Pat, always good to have you here on the show. Thank you for stopping by. So shares rose almost 4%, and obviously the company continuing to grow despite broader political and economic headwinds. What is driving this growth?
Well, thank you, Emily. Always great to be on the show with you. Overall, we saw very broad strength in our business and clearly across all the geos. Every product performed very well, great execution on the part of our team. And overall, we'd say this idea of the hybrid cloud, being able to combine the best of the private and public cloud together, and the momentum, as you note, with the Amazon partnership and our VMware Cloud on Amazon, that taken together has been this strategic inflection point that customers say, oh, I got it. We announced a very large deal, a $20 million deal, and the customers, quote, I just love, they said it was like manna from heaven. I could move to the cloud without changing my applications. And that momentum really is benefiting us across the business, and a great Q4 and a terrific year.
That is quite a colorful way to describe moving to the cloud and back. Tell us a little bit more about this partnership with AWS, what's actually happening there and how you're building on it.
Yeah, and we're now, we've been in this 2 years with them. And at reInvent, Andy Jassy and I were on stage together, and I was delighted to join him. And we really have seen what we'll call the third chapter of our relationship. First, the VMware Cloud on AWS. Second was RDS, bringing databases on-premise on VMware, and now their Outpost offering where Amazon hardware is coming on-premise, and we're working with them to deliver the VMware software. So the relationship is now very strategic. We have a roadmap of innovations. But the thing that really started to benefit us in Q4 was the VMware Cloud on AWS. The first chapter is really starting to get momentum, available across all three geos at this point. We've seen large deals landing across all three geos, and customers are really seeing the benefit of this unique integration of public and private. Number one public cloud with Amazon, number one private cloud with VMware, and now being integrated into this solution. Customers, like I said, manna from heaven.
So the information reported that you're also developing a partnership with Microsoft whereby you would bring your software to Microsoft's Azure cloud. What can we expect from this partnership?
Well, we would look to our long-term relationship with Microsoft as covering a range of areas. We don't comment on speculation, and this was speculation, and at this point, nothing else to add or describe with respect to Microsoft.
Okay, but would a partnership with Microsoft get in the way of your partnership with AWS, given that AWS is an Azure rival?
We have another program that we run called the VMware Cloud Partner Program, and as part of that, we have people like IBM and Alibaba as another example, as well as 4,000 other partners. So we do have a very broad program that we're enabling many other cloud partners to participate and really leverage the VMware software offering into the marketplace. So that program is something that we do look to continue to expand over time. But the VMware Cloud and AWS is a unique partnership. They're a preferred relationship. And as I said, this number one coming together with number one is a really powerful value proposition in the industry.
Dell went public again in December. How have things changed for you since then?
Well, it's been a really exciting time. And obviously, we did our major dividend, $11 billion dividend. I'd never written a check that was quite that big before, Emily, so that was sort of fun. But as part of that, it enabled this go public offering from Dell, the elimination of the tracking stock, and now you have a juggernaut hardware company in Dell, partnered uniquely with a fast-growing innovation software company at VMware, and the two of us really are making incredible progress in the marketplace, and we saw our business with them grow very substantially. We've achieved our synergy target with them. And maybe most importantly, we're seeing that we're creating unique value together. One of those was the VxRail product that brings together what's called hyperconverged, the integration of hardware and software. Think about it like a data center in a box and being able to deliver that as a uniquely engineered solution with them.
Okay.
We're also working on the client side with them. So together, we're innovating together as well as being successful in our go-to-market programs with them. A great relationship.
Pat Gelsinger, CEO of VMware, with us on the back of earnings results. Thank you so much, Pat, for stopping by. Coming up, we continue our coverage of Lyft's IPO. We're going to hear from one of the startup's largest shareholders. This is Bloomberg. Technology. I'm Emily Chang in San Francisco. Let's return to our top story, Lyft filing for a U.S. IPO. Just last month, we spoke to Rakuten CEO and Lyft board member Miki Mikitani. The Japanese conglomerate Rakuten is one of the biggest Lyft shareholders with a 13% stake in the company. We discussed his investment in Lyft, its competition with Uber, and working with the Chinese government to bring the ride-sharing business to Japan.
We invest in the ride-sharing company to understand what does autonomous driving mean to our product delivery strategy in the future. And also, we would like to know where the sharing economy will go. So now we have very deep understanding of sharing economy, not just limited to ride shares. We started to vacation rental home business in Japan. Now we're talking with Lyft, potentially launching Lyft in Japan.
Lyft they haven't done much international yet, so that would be a big deal.
If it takes place, yes. I don't know. There are lots of issues still.
What would need to happen? I mean, the Japanese taxi market is a hard one to crack.
Yes. Legally speaking, pure ride sharing is still illegal in Japan. So I think we need to be very, very smart.
Are you talking to the Japanese government? Are you trying to grease the skids for them?
I'm constantly talking with the Japanese government for many, many issues. And this one has been, I haven't been pushing it too hard because the reaction from the taxi unions is so strong. So I just want to be a little bit careful. So learning about what's going on, what can happen in the future, and also expanding our ecosystem. For example, the Lyft is now on our eBay platform. We do many businesses use technology of our portfolio companies, like the Visense, our visual recognition AI company. We use their technology for our shopping. And some, ended up just kind of pure investment. But we are trying to do investment which makes sense for us to do. We are not like, Kleiner Perkins, or we are not Sequoia. We are corporate venture fund, so we invest into the companies which has something to do, or we think we will have something to do with us in the future. But performance has been excellent, by the way.
Yeah.
Way better than any other VC.
What are your returns?
Our returns are like 28.5%
Wow.
IRR.
SoftBank is an investor in Uber and Lyft. Do you find that odd?
They are not really active. I don't know how much do they own.
Their Uber investment is much bigger.
Yeah, sure. Uber is much more ambitious company than Lyft, for sure. But I cannot tell you the percentage. But when John Logan came to my house, they were kind of desperate because Travis who is also a good friend of mine, was trying to crash Lyft. And I gave them $300 million.
What was their plea?
Plea was about $2 billion.
No, what were they asking you for?
Because they only had $100 million in the bank account. The burn rate was so high. Uber was trying to crash them, so they need to have help. But I did my homework, and I researched through my data team, and I found out, okay, 50% of young people, millennials in San Francisco, use Lyft, not Uber. I said, oh, well, this is encouraging news. And the share among the younger people were rising up, even the entire market share is very small. So I thought, okay, this company has the potential to reach to at least 20% market share, focusing on younger people. It's a little bit different. And they did it. And they did so well, executed. They partnered with us for the marketing. And now their market share is way bigger than what we intended.
So how do you think the Uber versus Lyft competition plays out?
I told to Travis a long time ago when he was very angry when I invested into Lyft. You need at least have two players for this kind of totally new services, which is going to replace huge, sort of service. We're talking about converting car ownership to mobility as a service. This is big, and I don't think would be just one company can do it. There need to be at least two or even three companies who do it, competitively. Otherwise, they're gonna face, many difficulties, antitrust, pushback from the drivers. So I think it is healthy to have, two companies competing each other.
Miki Mikitani there, Rakuten founder and CEO. Bloomberg's Eric Newcomer joins us now from New York with more on Lyft's global plans. First of all, Eric, what was your take there on Mikitani's description of the Lyft founders as desperate?
I think he's being honest. I mean, he was able to get such a huge position for Rakuten. They're the biggest holder, and then General Motors. And it is because Lyft really needed them. I mean, the Lyft founders both diluted their position to get outside investors. Neither of them hits that 5% threshold of shares. So they had to really sell down their stake to try and keep the company alive to fight with Uber, and Rakuten really sort of helped them stay in the game. So it was a prescient investment that's paying off well for Rakuten.
Describe some of the international dynamics at play here. Obviously, SoftBank is a smaller investor in Rakuten as well, but a much bigger investor in Lyft. I still don't get that.
SoftBank is, a major Uber shareholder with ride-hailing investments all over the world. There have been firms like Tiger and Cotu also that have sort of peppered ride-hailing with a bunch of investments. I mean, to some degree, it's almost like a public investor that sees that a space is going to be huge. You invest in only, one, Microsoft or Google, even though they both have cloud options, or do you say tech is doing well and we're going to own both? So I think a lot of investors, even in the private markets, once Uber sort of freed them up to make multiple bets, jumped in and took multiple bets across all these international players.
So now that we know what Lyft's financials are and have some more specifics, what do you think about how they stack up to Uber's?
Revenue for Lyft doubled 2017, 2018. We're talking 2.2 billion revenue. So the growth that Lyft has been able to do into the IPO is just going to be much more exciting than Uber's, which is a story of slowing growth because Uber was already so big. Uber's revenue, I think, is 11.4 billion. And growth Q3 to Q4 for Uber was like 2%. So really slowing down while Lyft has sort of that exciting growth. On the other hand, Lyft's losses on a relatively small base are pretty jarring. $991 million for the year. So we just have this dual situation where Lyft has exciting growth. It was able to insert itself into a market that, when Rakuten invested, it was an open question of whether it would really make it. But it had to pay for it, and it's continued to burn through a lot of money to build that position against Uber.
Right, losing almost half as much money as it's making. Okay, Bloomberg's Eric Newcomer, you're going to be charting the road to IPO for us. Thank you so much.
Thank you
for stopping by. All right, Apple CEO Tim Cook stood before his company's investors for the first time since the iPhone maker cut its forecast at its annual shareholder meeting this Friday. Bloomberg Tech's Mark Gurman was at Apple headquarters in Cupertino, California, and filed this report.
At Apple's 2019 meeting for shareholders, CEO Tim Cook talked up the company's in-house chip efforts, iPhone and iPad sales, and also hinted at strong ambitions in the wearable space, providing some color on the company's future roadmap and its new approach to developing products. Cook was asked if the company is going to be more bold and take more risks in the types of products that it develops. And Cook said the company is rolling the dice in, quote, planting seeds across different areas for future products. But the company won't disclose what they're working on well in advance because he only wants to talk about products that he knows for certain will ship. The company also indicated that all of its board members, which includes Cook, Disney CEO Bob Iger, and former U.S. Vice President Al Gore, have been reelected, along with approval for executive compensation. Two shareholder proposals that Apple said that should be rejected were in fact rejected in large numbers by company shareholders, including one for Apple to disclose the ideological or political leanings of its board members, and another one that would give shareholders a larger opportunity to have proxy access or name people or nominate people to the board of directors. Overall, Cook said he was optimistic about the company's future and the company of today, and he indicated a strong future product portfolio. The company is working on a bevy of new products for this year and next, including an AR headset, and it's also exploring the self-driving car market. I'm Mark Gurman for Bloomberg News in Cupertino, California.
Thank you, Mark. All right, coming up, Tesla came through with a surprise launch of a new Model 3 this week, but those aren't the only changes Elon Musk surprised investors with. We're going to discuss next. And later in the show, NASA wants to start sending American astronauts into space without the help of Russia. So it's turning to SpaceX. We will discuss this weekend's big test launch. This is Bloomberg.
Vehicles pitching downrange.
Hulu is nearing 2 million subscribers, while YouTube has eclipsed 1 million subscribers to online TV services, according to people familiar with the matter. The company's created the live services known as skinny bundles to compete with similar packages from conventional distributors like Dish. Well, Tesla CEO Elon Musk delivered a big promise Thursday, introducing a $35,000 shorter range Model 3. But the big reveal also came with some less exciting news for investors. On a call with reporters, Musk said Tesla probably won't post a profit in the first quarter, despite his past predictions. He then announced that more jobs would be cut as Tesla closes most stores worldwide, shifting sales online. Joining us from New York to discuss Bloomberg's Max Chafkin, and in Detroit, we've got Sandy Munro, CEO of Munro & Associates, who did a teardown of the Model 3. So, Max, Tesla shares closing down more than 7% today. Why are investors so disheartened after Tesla hit this amazing milestone?
Yeah, you really have to separate kind of the tech story, which is really, by any measure, an amazing achievement by Tesla, selling this electric car that's a very good car by most people's accounting for $35,000, a reasonable price. The issue here is that as part of this announcement, Elon Musk also said that they have to close a bunch of stores, most of their stores, in order to make a profit on this car, which is concerning on a couple of levels if you're an investor. One is kind of makes you wonder just how profitable can they be selling these cars at this price. Also, it's just such a dramatic shift for a company that until recently was talking about expanding the number of stores, and it just kind of makes you feel like, okay, maybe they're not fully in control. And I think investors are sort of reacting to that uncertainty.
Okay, let's focus on the tech part of this story. Sandy, given that you tore down a more expensive Model 3, Elon Musk himself yesterday said it is excruciatingly difficult to make this car at this price. So what is your outlook on a $35,000 Model 3?
Okay, so I believe that what's going to happen is that he'll have the growing pains that he had last time. His estimations and whatnot of how things are going to run usually don't kick off the way that he was hoping for. And so consequently, what's going to happen is he's going to see a few things that he's going to have to change as time goes on. So the same thing happened with the more expensive versions. They had to decontent here and there, and they had to change the way they did things, like getting rid of robots and whatnot and putting in people. So I believe that's what's going to probably happen.
So, let's talk a little bit about how Tesla is going to sell these cars now, closing the stores. On the one hand, you could look at this as he's getting, rid of a costly and perhaps wasteful part of the auto industry. On the other hand, this is very unconventional, and will people actually buy the cars online? How are investors seeing this?
I mean, obviously not well based on the stock's performance today. I mean, it's an interesting bet, because if Elon Musk is right, if Tesla can just sell, hundreds of thousands of cars a year on the internet, essentially, having people just buy it based on the reputation, or maybe because they've, driven in a friend's car or something, that would, kind of dramatically remake the auto industry, which is, totally dependent on these dealer networks, and, everyone test drives their car. It's a huge part of the marketing and kind of how the business is done. On the other hand, it just adds this additional layer of complexity, which is we've seen Elon Musk kind of do this, basically throughout his career. I mean, when they were launching the Model 3, they did it with, as Sandy said, with the robots, And so you could look at this as either as like a grand bet or another case where Tesla is kind of overcomplicating things, or just increasing the level of difficulty in a way that's going to make certain investors, a little scared.
Sandy, $35,000 is still a lot of money for a lot of people, and if you look at any add-on, you can get up to $60,000+. Are people going to buy Tesla just because it's a Tesla sight unseen?
I believe they are. The one thing I have learned about that car and Elon Musk is that this isn't a car company; it's a cult. And quite frankly, Elon Musk attracts people in a way that no one else. In fact, all you have to do is think, which car executive would anybody on the street know except for him? I mean, certainly that he's got that going for him. And quite frankly, he's got hidden plans, just like he did when he turned the seat heaters on in the back of the car, or modified the braking when Consumers Report gave him some static. He's going to pull some rabbits out of his sleeve. And I don't think anybody is going to buy a $35,000 car, because they're going to want autopilot and a few other things that are extra charges. We know that he can probably get down to that point, but he's left so many things inside the car, like ADAS and whatnot. And if you want it, all you have to do is phone up or whatever, or send him an email. he'll turn it back on, and you just pay your $6,000 to $10,000, and away you go. He's got a totally different business plan.
Indeed, he does, Max. So what does that mean for demand and supply?
Well, we don't know, and that's what's scary. So it is true that Tesla has an amazing following, that, the company thus far has rewritten the rules of selling, cars at the high end. There's definitely a following. What you don't know is how big this cult is, and that is, if you're an investor, that's what's a little bit scary. I mean, it's great. A cult is great as a marketing thing, but if you're an investor, a cult is also implies, instability, unpredictability. And all those things could work out well, but we just don't know. And the fact that there isn't a great track record of people buying cars in this way, or people, or sort of middle class people spending these amounts of money for cars is, we're in uncharted territory. It could go, basically one of two ways, and that's why you see this polarizing response to Elon Musk, where some people think he's a genius, and other people are just totally freaked out by him.
All right, Bloomberg's Max Chafkin, never mincing words for us, and Monroe and Associate CEO Sandy Monroe. Thank you both. We'll see how things shake out. Still ahead, could SpaceX be the future ride for U.S. astronauts to reach the International Space Station? This weekend's test launch could go a long way towards answering that very question. That is next. This is Bloomberg. SpaceX is gearing up for an unmanned launch this Saturday. And while there won't be any humans aboard, NASA's associate administrator is calling this a, quote, absolutely critical first step to get American astronauts into space. That's because NASA doesn't want to revive the U.S.'s ability to fly to the space station without buying seats on Russian capsules. To discuss, we've got Bloomberg Aviation reporter Justin Bachman with us in Dallas. So, Justin, what do we know about how this launch will proceed?
Well, it's going to be done very typical SpaceX launch, which they've done many times, and it's going to the difference is going to be the high-profile nature, because in this case, pretty much everything major has to work, because there's a lot riding on the United States' ability to get back to the space station without Russian taxi rides. So it's going to be similar to what you see in a SpaceX launch, but the stakes are much higher.
Obviously, this is a huge milestone. Tell us what success means, and if this doesn't come off, what failure means.
Well, success is important, and failure is even more of a problem here. I mean, it's hard to overstate how important this is to NASA and everything riding on it, as well as to SpaceX, because you're really talking about a point of national pride, a point of pride for the agency, a major stepping stone for commercial spaceflight, in the sense that this is not a NASA vehicle. This is for all intents and purposes, a private commercial launch, and NASA is putting finally their own people on something that NASA didn't build. So it's really important, and it's hard to overstate that things do need to go right for SpaceX.
So what's the potential for non-NASA folks to fly on this?
Yeah, it's a really interesting question, because neither side has said too much about it recently, but there is an opportunity down the line, once this becomes a little bit more routine for both SpaceX and Boeing, that you could see some people with means flying to the space station, potentially as tourists. And I think that that's something that all the parties here are somewhat interested in exploring further.
Now, Boeing is a competitor here. Talk to us about Boeing's vehicle. They're also another provider for NASA in this program.
They are. They've got a completely separate vehicle, which is still undergoing testing. It will fly without crew as well, expected this summer. And it's called the Starliner. It's a different design, but the same objective, same safety parameters, same everything else in that regard. But NASA very specifically went with two different companies here for access to the space station. And they did that in a very deliberate way, because they want to make this more of a both competitive and also a U.S.-built ferry service so that no longer have to ride on the Soyuz craft.
All right, Bloomberg's Justin Bachman, thanks so much for that update. We will, of course, be following that launch, if it happens, on Saturday. That does it for this edition of Bloomberg Technology. Next week, we're going to be live from New York City. We've got a great lineup, including Kathy Wood, ARK Invest CEO, Eric Hippo of Lehrer Ventures Managing Partner, and Che Huang, CEO of Boxed. And we're live streaming on Twitter. You can check us out at Technology and follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.